There are 10 mistakes that quietly cost ETF investors more money than almost anything else in the market. Not crashes, not bad luck, just habits, small, repeated decisions that feel safe or reasonable in the moment, but that compound into real, measurable losses over years and decades. Most investors never even realize they're making these mistakes because each one feels like common sense at the time. So let's go through all 10, one at a time, and really sit with why each one costs so much more than it looks like it does. The first mistake is chasing past performance, buying an ETF simply because it just had a great run, which almost always means buying near the top and eventually selling near the bottom. But here's the part most people get wrong about this mistake. Chasing what's going up isn't automatically a bad idea. It depends entirely on what's underneath the performance. Take semiconductors right now. They're one of the hottest sectors in the market, but that heat is backed by real fundamentals, massive earnings growth, massive revenue growth, real cash flow supporting the valuation. Chasing that isn't reckless. It's just recognizing that the fundamentals and the price are moving together. Now compare that to the ARK Innovation ETF back in 2022, which fell roughly 72% that year alone. Those companies were trading at price-to-sales ratios of 100, sometimes 200, completely disconnected from any actual earnings or revenue growth. Once sentiment shifted even slightly, there was nothing underneath the stock price to hold it up. And because most of those companies weren't profitable to begin with, they had to keep issuing new shares just to cover their ongoing losses, which added even more selling pressure exactly when the price was already falling. That's the trap. It's not the act of buying something that's gone up, it's buying something that's gone up for no defensible reason. So before chasing any trend, ask 3 questions. Is this backed by sustainable earnings growth that's likely to continue? Is it pure speculation, propped up by hype rather than fundamentals? Or is it simply a cyclical swing like oil jumping from $50 to $100 a barrel that's unlikely to keep compounding at the same rate going forward? We saw that exact pattern play out with fertilizer stocks during the Iran crisis. Companies like CF Industries and Nutrien spiked hard, investors piled in late, and then the prices came right back down to roughly where they started once the rally faded and the underlying cyclical driver cooled off. Even buying something as mainstream as the S&P 500 or the Nasdaq is technically a form of chasing performance. But there's real logic underneath it, because the growth those indexes represent tends to be durable rather than a short-lived spike. The test is simple. Is this growth sustainable 5 years from now? Will we need more semiconductor chips in 5 years, given how fast data centers, computing demand, and next-generation wireless infrastructure are expanding? Almost certainly yes, so that kind of growth is durable and worth paying up for. Will we need meaningfully more grocery stores in 5 years? No. The population is stable, and that demand simply isn't expanding at any real pace. That's exactly the kind of sector you shouldn't chase at a rising valuation, because there's no future earnings growth coming along to justify paying more for it today. The second mistake is panic selling every time the market dips. This year alone brought sharp corrections in January and again around the Iran conflict in the spring, and the pattern that played out both times was almost identical. The investors who sold into the panic locked in real losses. The investors who bought the dip or simply held through it came out ahead within months. Why does this keep happening the same way every single time? Because the underlying earnings growth almost never actually stops during these dips. Through every one of this year's sell-offs, companies like Google kept posting accelerated earnings and accelerated revenue. Their cloud division alone is now growing around 60%, sharply higher than it was a year earlier. The same held true for Microsoft, Amazon, and Micron. When a stock that's already risen a great deal pulls back 30 or even 50%, that's usually just the market doing ordinary price discovery. It doesn't mean the underlying business broke. It just means the market briefly reset its expectations before continuing on with the same long-term trend. Compare that to a typical utility stock, very stable, rarely crashing, but also rarely surprising anyone to the upside, because the market has already priced in almost everything that stock is ever going to provide. Taking on some short-term volatility in exchange for real long-term upside is, for most growth-oriented investors, worth it. And if you can genuinely stomach the dips and keep adding to your positions through them rather than running from them, that's actually one of the biggest structural advantages a retail investor has over an institution. You can't be forced to sell the way a leveraged fund can be forced to sell during a downturn. The healthiest approach is to buy quality, profitable, growing companies and resist the urge to sell just because there's a dip. Selling low, watching the market rally back without you, and then buying back in at a worse price than you sold, that's a genuinely disastrous cycle, and it's driven almost entirely by emotion rather than any real analysis. The third mistake is owning a pile of ETFs that all secretly hold basically the same companies, something like VOO, SPY, IVV, and SBLG all held at once, then stacking SCHG, VUG, and MGK on top of that. If you're simply splitting money between something like VOO and SPY, you're not actually hurting your returns at all, you're just adding unnecessary clutter to your account, since those funds track nearly identical indexes. The more interesting and useful question is how much genuine diversification is actually helpful. The Nasdaq 100 holds around 100 companies. The S&P 500 holds 500. A more concentrated growth-focused fund might hold closer to 40. Here's the right way to think through it. If you genuinely believe that 50 of the S&P 500's 500 companies are going to meaningfully outperform the other 450, then diversifying further beyond those 50 is actually lowering your expected return rather than meaningfully reducing your real risk. Take a company like Ford, where revenue has been shrinking for years. Selling a strong, growing holding like Micron in order to buy Ford purely in the name of diversification doesn't reduce your risk at all. It just adds a weaker holding to your portfolio. That's what bad diversification actually looks like in practice. Diversification that lowers your expected return while simultaneously raising your risk isn't really diversification. It's dilution wearing the costume of caution. And realistically, if you already own several overlapping large-cap ETFs, you probably already own hundreds of underlying companies through them. Adding something like a niche regional fund purely to say you're more diversified usually isn't necessary if it comes at the cost of overall portfolio quality. The fourth mistake is playing it far too safe, sitting heavily in short-term treasury bills, loading up on low-volatility dividend ETFs like SCHD as your core holding, just to keep the ride smooth and predictable. This one depends heavily on your age and your actual need for cash. If you're already retired with no earned income coming in, you genuinely do need more cash sitting on the side. But if you're investing with a 20 or 30-year time horizon ahead of you, and a 1 or 2 month pullback feels unbearable, something in that strategy is mismatched with your actual timeline. On the opposite end, going too far the other way is just as dangerous, dumping your entire portfolio into unprofitable, purely speculative companies with price-to-earnings ratios in the hundreds, the way some investors have piled into early-stage quantum computing startups. That's not brave investing. That's simply high risk without a reward that matches it. The core of a genuinely long-term portfolio should be built around large, profitable, reliably growing companies. Smaller and mid-cap companies, generally speaking, tend to carry much higher stock-based compensation, far less reliable earnings, and a meaningfully higher chance of swinging suddenly into real losses. If you want some exposure to riskier, unprofitable, high-upside names, that's fine. Just keep that exposure to a small slice of the overall portfolio, rather than letting it become the core of it. The fifth mistake is overloading on dividend and income ETFs, covered call funds, put spread income strategies, plain vanilla dividend funds like SCHD. These products absolutely have a place for the right kind of investor, but for most people, they quietly underperform growth-focused funds once you fully account for taxes, capped upside, and fees. This mistake is genuinely case by case, though. If you're already retired and you're using these funds to manage your own predictable income stream, instead of paying an advisor to periodically sell shares for you that can make real, practical sense, you're effectively swapping an advisor's fee for a different kind of structure. But for most long-term investors still building wealth, holding growth investments, and simply selling a small number of shares yourself whenever you actually need cash tends to work out better over time, since you're not regularly spending down your portfolio in the first place. A lot of these income-focused products also carry real, often hidden costs, particularly wide bid-ask spreads on the options strategies involved, which quietly raises trading costs in ways most investors never notice or calculate. That said, these products have become genuinely popular for a reason. That popularity tells you they're solving a real, felt need for a lot of people, even if it isn't always the most tax-efficient way to solve it. The sixth mistake is refusing to buy at all-time highs. Looking back a year or two after buying into a market at a fresh all-time high, it has worked out well far more often than it hasn't. If you already have the money available and you genuinely believe in what you're buying over the long term, putting that money to work right away generally beats waiting around for a pullback that may or may not ever come. This is fundamentally a game of probabilities. There's always some chance the market dips shortly after you buy in, and you end up wishing you'd waited, but historically, sitting on the sidelines waiting for a better price tends to cost far more in missed gains than it ever saves in avoided losses. This logic applies specifically to long-term investing, not to short-term trading, where timing genuinely matters more. If it's the right asset for you over a long horizon, the exact entry price you paid ends up mattering far less than simply getting the money invested and staying invested. The seventh mistake is simply not investing enough of what you actually have available. Extra cash, a bonus at work, tips from a side job, a bit of unexpected income often quietly gets spent instead of invested, without much thought behind the decision either way. If investing is something you take seriously, and you're in your 20s or 30s with decades of runway still ahead of you, consistently putting that extra money to work builds an enormous compounding base for your future self. Life naturally changes that calculus over time. Of course, a spouse, kids, a bigger home, more plane tickets, when the whole family travels together, spending naturally rises, and that's completely normal and expected. But the underlying principle holds steady at essentially any income level. A higher contribution rate almost always beats a lower one, even before you factor in any difference in what you're actually invested in. Someone consistently investing $500 a month is going to outperform someone investing $200 a month over time, purely because of that gap in ongoing contributions, long before any difference in stock picking or strategy even enters the picture. The eighth mistake is ignoring the tax side of investing, almost entirely skipping Roth IRAs and 401(k)s simply because the money is locked up until age 59 and a half, without ever fully factoring in how much that tax treatment is genuinely worth compounded over several decades. For the average investor under the relevant income limits, maxing out a Roth IRA and then a 401(k) is about as close to a financial no-brainer as exists. Put the money in every single year without fail. It becomes more nuanced once your income rises high enough that a Roth IRA isn't directly available anymore, and a backdoor conversion becomes the only route in, since you lose the upfront tax deduction on that contribution, though the tax-free growth going forward still carries real, lasting value. The genuinely tricky part for a lot of people is balancing retirement accounts against nearer-term needs. If a house purchase is only 3 to 5 years away, locking every available dollar away until 59 and a half doesn't make practical sense either. It's a real, ongoing balancing act rather than a one-size-fits-all rule. Broadly speaking, performance and tax efficiency matter roughly equally over the long run. ETFs carry a genuine structural advantage here as well, since a fund doesn't trigger a taxable event for its own investors simply because it sells one underlying stock and buys another internally. Taxes only actually come due once you personally sell the ETF itself, which makes ETFs meaningfully more tax efficient than constantly trading individual stocks in a personal brokerage account. The ninth mistake, and arguably the single biggest one on this entire list, is not chasing growth at all. Investors tend to sort themselves into dividend investors, income investors, and growth investors, and a large number of them end up settling into some kind of hybrid approach that quietly caps their total returns without them ever fully realizing it. The real, honest goal should be maximizing total returns, not risk-adjusted returns, not income generation, specifically total returns, which is the exact approach taken by the most consistently successful long-term investors in history. A lot of investors carry an instinctive, largely emotional bias. When something has been going up, they assume it must now be overpriced, and when something has been falling, they feel like they're finally getting a genuine deal. But a falling stock is very often falling precisely because that company's earnings and revenue are actually declining, and the broader market is voting with its feet. The same basic logic as customers naturally choosing one store over another because it's simply better run and provides more value. When revenue and earnings are rising instead, that's the market directly telling you that people want more of exactly what that company is providing. The real goal is to be biased toward that kind of demonstrated success, while still carefully avoiding the purely speculative names that carry sky-high valuations with no earnings behind them at all to justify the price. A market cap-weighted index like the S&P 500 naturally balances a lot of this out on its own. You'll always end up holding a handful of speculative names somewhere in there, but you'll usually hold a roughly offsetting number of genuinely undervalued ones as well. Trying to go meaningfully further than the index requires real, careful, nuanced research into the underlying companies themselves in order to actually justify the added effort and added risk. And the 10th and final mistake is failing to avoid small-cap, unprofitable companies almost entirely. That doesn't mean you'll never miss out on a future winner. You might well miss investing in a company like Amazon during its early, unprofitable years. But that miss doesn't actually hurt much if you were instead holding something like Google, which was reliably profitable the entire time and has ultimately performed just as well over the long run. Missing a handful of individual winners along the way doesn't meaningfully damage an overall portfolio, provided that portfolio is consistently built around quality, profitable businesses carrying genuinely lower risk. The other half of this final mistake is chasing whatever happens to be hot in the moment instead of sticking to a clear, consistent strategy. Buying into oil, panic selling the moment it dips, jumping straight into Bitcoin afterward, then panic selling that cycle essentially guarantees buying near every top and selling near every bottom over and over again. And every single time a portfolio gets turned over this way, there's a real risk of realizing capital gains taxes along the way, which quietly compounds against you across the decades that follow. One genuine advantage of holding a well-run ETF for the long term is that the fund itself can rotate weaker companies out and add stronger ones in internally the same way a major index might drop a shrinking company and add a fast-growing one in its place, all without ever triggering a personal taxable event for you every single time that happens. A quick word about a sponsor of today's video. Markets remain unpredictable, rate expectations keep shifting, equity volatility persists, and ongoing questions around tariffs and the AI trade may continue to drive real uncertainty going forward. NEO's ETFs may offer a way to stay invested across equities, fixed income, and alternative asset classes while seeking outcomes like monthly income, enhanced tax efficiency, genuine upside potential, and in some cases, a real measure of downside protection. From equity and alternative high-income strategies to enhanced fixed-income strategies, NEOS aims to deliver the next evolution in options strategies for today's markets. You can explore their full lineup at neosfunds.com. Investors should carefully consider the investment objectives, risks, charges, and expenses of exchange-traded funds before investing. To obtain an ETF's prospectus containing this and other important information, call 800-664-9856-77 or view and download a prospectus at neosfunds.com. Please read the prospectus carefully before investing. An investment in NEO's ETFs involves risk, including possible loss of principal. NEO's ETFs are distributed by Foreside Fund Services, LLC. So that's all 10 laid out in full. None of these mistakes are especially complicated on their own, chasing hype, panic selling, stacking overlapping funds, playing it too safe, overloading on income products, refusing to buy at all-time highs, underinvesting relative to what you actually have, ignoring taxes, avoiding growth altogether, and holding on to unprofitable speculation instead of quality businesses. But avoided consistently, year after year, across an entire investing lifetime, these 10 small decisions add up to the real, measurable difference between an average portfolio and a genuinely strong one. If this was useful, drop a like on the video, go check out the previous interview linked below, and I'll see you in the next one. This video is for educational and informational purposes only and is not investment, financial, or tax advice. I am not a financial advisor. Please always do your own research before making any investment decisions.